Hello everyone. The recent monetary policy review left rates unchanged, which was broadly in line with ours as also market expectations. But clearly there are a couple of things which are worth highlighting from a policy standpoint. For starters, we saw 5 members of the MPC vote for a status quo against the total of 6. So there was clearly a divergent view visible this time within the Monetary Policy Committee members. Number 2, we have seen a decline or a reduction in the inflation range target mentioned for FY18, both in the first half as also the second half. That again is a favourable positive. And last but not the least, though the monetary policy stance continues to be in neutral mode or a neutral stance, the incoming data, we believe, as guided by the RBI, could create a space for further rate accommodation. So I think that would be the key story or the key driver in our mind for the bond markets going forward. So even though there was no rate action, I think the verbal suasion or the verbal guidance we believe will be taken as a positive cue for the bond markets going forward. The 10-year benchmark yield before the monetary policy decision was trading at around 6.64% levels. At the close of the market session post-policy, the yields softened across the board 5 to 10 basis points and the 10-year benchmark yield closed at 6.56%. There has been a reasonable softening across the yield curve, and another trend that we foresee happening in the bond markets over the next couple of quarters is a flattening of the yield curve, which means the long end of the yield curve above the 20, 25, 30-year segment is likely to fall at a faster pace than the 5 or the 10-year segment. Therefore, we believe that alpha generating opportunities in the bond market, even if the 10-year benchmark does not move or soften very meaningfully, will still remain from a market standpoint. Do we expect rate cuts going forward? Well, it might sound very cliche, but we have been consistent with our outlook that there could be one more rate cut in 2017 or FY 2018. That view still remains, and probably if inflation continues to behave in a sustained mellowed manner over the next couple of months and the incremental outlook remains to be benign, we would not be surprised to see a rate cut as early as the August policy review. But of course, timing agnostic, should investors continue to remain in duration funds is the question that most investors and most advisors ask. Again, we've been fairly straightforward in saying the answer is a plain, simple yes. In fact, we wrote out a note to our stakeholders on the 29th of May stating that the factors macro, both global as also domestic, has visibly created a case for softer bond yields, and that view seems to have panned out or is still midway. So for those investors who are still in duration funds, we don't believe that it is time to profit book as yet. The liquidity in the system will continue to linger around adequately enough to keep bond yields supported, and a combination of domestic and the global macro would give reasonable tailwinds for bond yields to remain at the current levels with an easing bias. For fresh allocations at the current juncture, we still believe on a risk-reward basis for a stable bias portfolio, corporate bond strategies with higher accruals could be favored, but tail-end allocations to duration strategies which are actively or have a flexi mandate could do well even right now with a 2 to 3 year investment perspective. Broadly, if I were to summarize, it's like as if there has been light at the end of the tunnel from a bond market standpoint, which has been lingering in midst of uncertainty for a fairly long period of time. And after the monetary policy guidance, things seem to be emerging slightly more clearer than what it was a couple of quarters back. So the अच्छे दिन for bond market investors, we believe, should continue the course for FY18 as well. On that note, stay happy, stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.